Hello, I'm your mortgage lender, Rob, and welcome to 10 Minute Tuesday. This is a live and recorded video I host every few weeks where I'll be sharing real estate and mortgage news, tips, hacks, and updates in 10 minutes or less. Q&A at the end, so please drop your questions in the chat whenever or unmute yourself at the end to ask your question. Today's topic is Biden rate changes. What is it? What does it mean? How does it affect you? We'll talk about that. First, we always go over a quick rate update. So this is based on today, June 13th. So general rates, not your specific scenario, but what someone could expect right now. We've got conventional and then your government loans, your FHA, USDA, and VA. We got about 6.625 versus 6%. We're down a little bit in the last 3 weeks. The reason for this is over the last couple of months, we saw rates increase quite a bit. And we're just seeing a softening of that. We were expecting, there's been back and forth on the news about, will the Fed hike rates again? There was some more than 50% chance, less than 50% chance. And it's kind of at, I don't know what it is at right now, to be honest. I think we're expecting a pause in rate hikes right now. So the Fed meeting is happening today and tomorrow. So all eyes on that and seeing what kind of comments they give us, which is more important to projecting the next move for the Fed. So we'll see. Nothing big changing lately. Topic of the day is the Biden rate changes. What is it? What does it mean? How does it affect anybody? You may have remembered things like this in the news. This was about a month ago when this really hit the news cycle. And there was a lot of confusion, a lot of people on social media talking about what this was accurately and inaccurately. And so today I want to demystify this. I have talked about this in the past. I made a few Facebook posts about it. So I want to just really give the technical, the facts about what this is and how it affects people, how it's not really that big of a deal. So this is going to be a technical talk or conversation today. It won't be that long, but I will explain the inner workings of how this works a little bit and how it affects people. And most importantly, how you can communicate this to your buyers, or if you're looking to buy, just understand it in general. So this on the screen here, this technically is true, but it's confusing the way it's written. So I'm a lender, and I've been doing this for a decade, so I understand these things from an inner workings point of view. So I want to explain this today to someone who doesn't have a lending background. So I'll do my best to make sense of this. Some terms are important. So first off, we're talking today about all the percents you're going to see are not interest rates. It's going to be fees. Now, fees are also expressed in a percentage or a point. So 1% equals 1 point. 1 point is 1% of your loan amount as a fee. So that means if you're borrowing $500,000 and you're paying 1 point, then you're paying $5,000. So these things on the screen here, surcharge, fee, discount, they're kind of the same thing. Fee, discount means a fee to get the discount, not a discount, not like a sale. So 1.5% fee discount actually means a fee. So let's just analyze this real quick. So 740, or the left one, 1% surcharge, 740 or higher FICO score with a 15 to 20% down payment. It's actually 15 to 19.99 down payment. 20% has a different bucket. So I suspect whoever wrote this just grabbed something that they didn't understand and showed the world. So simply what that means is that 740 to 759 FICO buyer with 15 to 19.99% pays a 1% fee. Now, every loan has a fee. It's higher or lower depending on your brackets. Second one, same thing. Below 679, 5% down or less, that is the correct fee, 1.75%. And we'll explain a little bit more about what that means and, more importantly, what it doesn't really do. So this chart I made, this is the change in fee, not the fee itself. So you can see based on my next slide, I'll show you real quick. This is a before and after. We'll get to this in a moment here. So you can see where things have changed. And so I guess I'll back up a little bit about what this whole thing means. So the rate changes that we're alluding to, I'll go back. The rate changes we're alluding to is going to be the change in the risk adjusted fees. They're called loan level price adjustments. So the ones that change were based on down payment and credit score. So every loan has a risk adjusted fee attached to it, generally based on risky parameters. So things like down payment and credit score are the two most important. So a lower credit score is going to have a higher risk. So a lower credit score buyer is going to have a higher fee compared to a higher credit score buyer, all things being equal. The same is true for down payments, but that one's kind of confusing because of the way it was changed. But generally speaking, a lower down payment is going to be a higher risk loan because there's less skin in the game for that end owner. Now, we have, if you put 20% less than 20% down, you carry mortgage insurance. So that offsets some of that risk. So you do see a decline in some of the fees there. So that part's a little confusing. So that's what this is all about, is those risk-based fees. Now, there's also other risk-based adjustments, things like buying an investment property instead of a primary residence. That's a higher risky loan. Multifamily property, condos have an adjustment. A lot of different things that have adjustments. So, all right, so going to this heat map. So here's the changes. So you can see green means got better, red means got worse. And it's a heat map, so you can see the differences. So certain of these things got a little better. So you can see the people under 680 credit score, their fees got better, but they're still more expensive than everyone else. That's the part that was confusing, is everyone thought that having a lower credit score would give you a better loan. Not true, never true. I don't think it'll ever be true. The biggest change is people in that middle there, that right around here in the middle here, that looks like it's 720 to 759 FICO score and 15 to 19.99% down payment. The numbers at the top are loan to value, so it's the opposite. 20% down means 80% loan to value. It means you're financing 80% of the value, loan to value. So look at these in reverse. So 80 to 85 is 20 to 20 or 15 to 20%. So you can see the biggest changes happened to people in that middle there, but it doesn't mean they're paying more. So the more this type of stuff went around the internet and just got everyone in a frenzy as they didn't understand it. So this is a better, clear picture. So the left is before, the right is after. They're lined up horizontally, so they match credit scores. The new change is introduced, or it changed. I guess no, it introduced multiple brackets above 740. Before, being above a 740 FICO score didn't matter. Now there's a 740, 760, and 780 FICO score bracket, and then they removed the 620 to 639 bracket. Now it's everything below 640 is in the same bucket. So on the left, you can see there was a really sharp drop off at 680, below 680 credit score. So once you dropped below 680, you had a sharp increase in fee. And I forgot to mention this in the beginning. This only applies to conventional loans. Your FHA, USDA, VA, which are your government loans, this doesn't apply to them. So this is conventional buyers. We'll talk a little bit more about the implications of that. So, okay, so the old one, you can see it was a much better if you were above 680 and really painful if you were below 680, so 679 or lower. What this meant was anybody below 680 almost never used a conventional loan. I've had hundreds of loans that I've originated over my career, and I could probably count on one hand the number of buyers below a 680 credit score who used a conventional loan. That was just the FHA buyer. There was not a lot of good reasons. So now, what you can see is, if we look at this 660 and below, the under 680, it's 660 to 679. So that line right there. So the fee went from, in the twos, 2.75, 2.25, depending, down a bit. Yeah. So their fees were reduced. They're still expensive. And they're still more expensive than the higher credit score people. At the same time, FICO scores above 680, their fees were increased in many cases. So this heat map, you can, if you want to pause the video and stare at this for a little while, you can see the changes. Now, again, this is not the change in your rate. This is the change in your fee. Now, generally speaking, if you an increase of a fee of 1% increases your rate about maybe a quarter to 3/8, 0.375. So it's about a 4-to-1 ratio. It's not a perfect. It's always different. It's not linear. So it's confusing. So this is the change. So how does this affect buyers? The most important part of this. So if you're still with me on this topic, this affects buyers. It doesn't really affect people in a lot of ways, because the people that this Biden rate change thing benefited, how they're saying, oh, we're helping people with low credit scores. No, they're not, because people who were below 680 already weren't using conventional loans. People below 680 were using FHA loans. These changes did not change that. Those buyers, those sub 680 FICO score buyers, are still going to use FHA loans. or VA or USDA if they're eligible. They have similar rates. So no benefit to the sub 680 FICO score community, in my opinion and based on my experience. What it did do is it hurt buyers above a 680 credit score because now their fees were increased. And what this has done is it pushed more people into FHA loans. I talked about this on my last 10-Minute Tuesday. You can go to my website, link in the description, mortgagebyrob.com, and you can see the last 10-Minute Tuesday. I talked all about FHA loans, and it was on this topic for this reason. So what this has done is just pushed more people into an FHA loan, which isn't a bad thing. FHA is a great loan. It has very low down payments, very good interest rates. And a couple months ago, FHA dropped their mortgage insurance premiums. So that was one of the biggest benefits because a high credit score buyer got pretty low mortgage insurance on a conventional loan. Well, now their rates are higher and the mortgage insurance is better on FHA. So it really closed that gap. And for some real world examples, I've had a few buyers recently in the 740 FICO score range and buying a home in the mid 400s. They're all going FHA, even though they have a great credit score and would have been a great contender for conventional last year or earlier this year. Now FHA is a better option, saves them a couple $100 a month. So that's all this did. There's not much that is actually going to change. What I would say is to a buyer is how does this fit? One, you can always defer to a lender, defer to myself. That's probably the easiest way is, talk to a lender about what these changes are. But the short answer is it didn't really help anybody. This is more pandering, it looks like, based by an administration who wants to show like they're doing something, which did absolutely nothing. So waste of time, as unfortunately we see in our political system on all sides. So that's that. If you have any questions, go ahead and drop them in. I'm taking a quick peek here. I don't see anything. So if someone wants to unmute themselves, feel free. But I don't think so today. So thank you for your time and have a great rest of your day and rest of your week.